In this free video course, you will learn everything you need to know about crypto trading. You will learn about crypto basics, some of the best trading platforms, and of course, how to analyze charts using technical analysis. I will also show you guys how to claim multiple free bonuses to help you out on your crypto journey. Alright, so let's begin this course by taking a look at what you can expect to learn in this video. And the very first thing we're going to take a look at is some crypto basics. In order to trade crypto effectively, it's very important to at least have a basic understanding of what we are trading. So in the first chapter, we will take a look at things such as, what is cryptocurrency in the first place and why would you trade cryptocurrency? So what are the pros and cons with crypto trading? We will also take a look at some basic but very fundamental concepts you need to understand to trade cryptocurrency, such as what are stablecoins, what is a cryptocurrency pair, what are the risks that is involved in crypto trading, and so on and so on. Chapter 1 is a very important foundation for the rest of the course. After chapter 1, we are ready to take a look at the best platforms for trading cryptocurrency. And depending on how you are planning to trade cryptocurrency, so for example, are you planning to day trade, are you planning to swing trade, or perhaps you are planning to be more of an investor, different platforms will be useful for different purposes. And I will, in a step-by-step manner, go over some of the best crypto trading platforms, the pros and cons. And if you plan to sign up for a platform, I will have links to all platforms down in the description and the top comment of this video, where you will find different kinds of discounts and bonuses for the platforms. So make sure to have a look in the description and the top comment before you sign up, so that you don't miss any bonus. In the next chapter, chapter 3, we are going to do an introduction to TradingView. And TradingView is, according to me and tons of other traders, the best platform when it comes to analyzing charts. So when it comes to crypto trading, many of these crypto trading platforms right here will have some tools that you can use to analyze charts. But what I usually recommend is that you have a separate platform where you do your analysis, because TradingView have so many more tools and more advanced tools compared to many of the crypto trading platforms. So one of the most common setups is to have one platform where you actually buy and sell your cryptocurrency, and one platform where you do your analysis. But as I said, for some of the crypto trading platforms, you can actually both do your analysis and buy and sell in the same platform. And when it comes to TradingView, you can actually also connect some of the crypto exchanges to TradingView as well. So make sure, guys, to pay attention to chapter 3. In chapter 4, it's finally time to take a look at how do we actually buy and sell cryptocurrency. And for this chapter, I will walk you through in a step-by-step manner, all the way from signing up to a crypto exchange to buying your first cryptocurrency. And I will try my very, very best to make this chapter as simple and straightforward as possible. Last, but definitely not least, guys, in chapter 5, we're going to take a look at how to perform technical analysis of crypto. And technical analysis is basically techniques and tools we use on the price chart in order to know when to buy and when to sell cryptocurrency. And chapter 5 in this video will be a pretty long chapter, but in order to get a basic understanding of technical analysis, we can't make this chapter super short. We need to go into depth in order to get a basic understanding of what to look out for in order to find high probability buy and sell signals on the crypto charts. All right, so now then, the very first question we of course have to ask ourselves is, what is crypto? And in very simple terms, I will try to make this whole video as simple and concise as possible, so I will not go into very esoteric explanations and complicated language. I will try to keep it very simple here. And in very simple terms, crypto, or in other words, cryptocurrency, is a digital form of money. Or in other words, it's a digital form of value. And cryptocurrencies are based on something called blockchain technology. And if you're watching this video, you have probably heard about blockchain technology. And blockchain technology is a pretty complicated concept to really understand, but in very simple terms. Blockchain is basically a secure public digital ledger. And this might sound complicated, but a public digital ledger is basically a public list of transactions. So it's a list where you can see all the transactions, and since it's public, it means that everyone can see this list of transactions. So this is, a thing that makes cryptocurrency very transparent, because everyone can see the list of transactions. They can see all the transactions that are made on the blockchain. And another important aspect of cryptocurrencies is that they use cryptography for secure financial transactions. And once again, cryptography is a complicated concept here, but in very simple terms, you can think about cryptography as the use of code to keep information safe and private. So cryptocurrencies are coded here in a specific way in order to keep the information safe and secure. And another commonality between pretty much all cryptocurrencies is that they are decentralized. At least they are decentralized to varying degrees. And decentralization basically means that no single entity, so for example, no single bank or financial institution controls cryptocurrencies. Cryptocurrencies operate and are controlled by a network of computers, and these computers in the network are called nodes. And if this right here sounds complicated, don't worry, this course is about actually trading cryptocurrency. But, in order to trade cryptocurrency, I think it's a good idea to have at least a very basic understanding of what you're actually trading. So if you, only know about these things I recently told you guys, you should have a, very basic understanding of what cryptocurrency is, and that's good enough to be able to actually trade crypto. All right, so now when we have a basic understanding of what cryptocurrency is, the next question we of course have to ask ourselves is, why would we trade crypto? What are the benefits of trading crypto? Well, the first clear benefit of crypto trading is that the market is open 24/7. So crypto markets are open 24/7, which means that you can trade cryptocurrency at any time. So if you want to, you can trade cryptocurrencies on weekends, you can trade cryptocurrencies on nights, on holidays, and basically any time. The crypto market is never closed. And if you compare this, for example, with the stock market or even the Forex market, the stock market is only open, certain hours every single day. The stock market is closed on weekends, closed on holidays, and so on and so on. But that problem you will not have when you trade crypto. You can always trade crypto, and that is a first and big benefit. The second benefit here is that cryptocurrency has high potential returns. And what do I mean by this? Well, cryptocurrencies are very volatile. This basically means that cryptocurrencies moves a lot. So you will see, fast movements to the upside, but you will also see fast movements to the downside. So, high potential returns means that you can make a lot of money trading crypto, but also, and this is very important, you can also lose a lot of money. So if you are a good crypto trader, you can make a lot of money, but if you are a bad crypto trader, you can lose a lot of money. So before trading crypto, it's very important to learn about techniques on how to trade. And later on in this video, as I already said, I will have a very long section about technical analysis, where I will go over in a step-by-step manner some basic concepts of technical analysis that you can use to trade crypto. And also, after you have watched this course, on my YouTube channel, I have tons of other trading courses where I dive much deeper into technical analysis. So after watching this course, I actually highly recommend to check out this playlist right here. In this playlist, you will find all the educational trading courses I have made so far on the channel, and more is coming soon. The third benefit when it comes to crypto is global access. So one very big benefit when it comes to trading cryptocurrencies is that you can trade them from anywhere in the world. The only thing you need is that you need to have access to the internet. So you can trade cryptocurrencies from anywhere as long as you have internet access. And that is another big benefit of trading crypto. All right, so now when you know about the benefits of trading crypto, it's time to start taking a look at some different types of cryptocurrencies. And here on the screen, you can see some of the most common cryptocurrencies. We have Bitcoin right here, which is probably familiar to all of you guys. We have Ethereum right here, and right here we have a cryptocurrency called Tether. Tether is a stablecoin, and stablecoins are very important when it comes to crypto trading, and we will talk more about stablecoins later. Bitcoin is also a special type. It's what I call a money cryptocurrency. And Ethereum is actually yet another type. It's a type of cryptocurrency where you can build smart contracts. But so now let's take a look at some different types of cryptocurrencies. And the first type here is money cryptocurrencies, or in other words, payment cryptocurrencies. These are basically cryptocurrencies where the purpose of the crypto is to be money. So these cryptocurrencies need to be able to store value. You need to be able to divide the cryptocurrencies into small amounts. And the cryptocurrencies should also be easy to move. It should be easy to trade the cryptocurrencies and buy stuff, no matter where in the world you are. So some examples of payment cryptocurrencies is, first of all, the biggest and most famous one, which is Bitcoin. But we have some other examples right here. Litecoin is another example of a payment cryptocurrency. And another one is, Bitcoin Cash, which I think is a fork of Bitcoin. The next type I want to talk about here is the smart contract cryptocurrency type. And remember, Ethereum right here is an example of a smart contract cryptocurrencies. Some other big ones are Cardano and Solana. So these three examples are different blockchains where you can create smart contracts. And explaining smart contracts is a little bit out of the scope of this video, but it's still important to understand that, different cryptocurrencies have different purposes. So for example, Bitcoin and Ethereum are very different kinds of cryptocurrencies. So it's not really like, for example, Bitcoin and Ethereum are not really competing against each other because they are, different kinds. The next type I want to talk about is something called altcoins. And, altcoins is not really a type of cryptocurrencies, but altcoins is a very common word that you will hear all the time. And when we talk about altcoins, what we mean is basically all coins except for Bitcoin. So all coins except for Bitcoin are, an umbrella term for these cryptocurrencies are altcoins. So for example, Ethereum is an altcoin, Litecoin is an altcoin, and so on and so on. The next coin type I just want to mention here real quick is something called meme coins. And what is a meme coin? Well, meme coins are basically cryptocurrencies that are based on, most of the times they are based on internet memes and internet jokes. And some examples of meme coins are, for example, Dogecoin, Shiba Inu, and Pepecoin right here. And you may of course wonder, why would you trade meme coins? Do they even have a use case or anything like that? Well, first of all, some of the meme coins actually have pretty decent use cases. Some of the meme coins can work well as money, so you can buy and sell things. You can actually buy and sell things with meme coins. And the other thing we need to know here about meme coins is that as a trader, if your goal is to only buy and sell something, you don't really have to care a lot about, you know, the actual project. If you are investing, that's a different story. But if you're only trading, the only thing you care about as a trader is if the meme coins are moving a lot up and down. Because when something moves a lot up and down, that means that we have opportunities as traders to make money out of these movements. And many of these meme coins actually have very large movements. So for example, Dogecoin is probably the most famous meme coin, and Dogecoin can move a lot. For example, Elon Musk on X, he tends to have periods when he tweets a lot about Dogecoin and so on, and that can cause extreme price movements. And these large price movements, we as traders can use as opportunities to make money. So even though most meme coins will probably be a bad investment long term, it's definitely viable to trade meme coins. Last but definitely not least, we have a category called stablecoins. And for traders, stablecoins is very important to understand. So I will have a separate slide where I talk about stablecoins. But for now, let's just take a look at a few examples. So one example of a stablecoin is USDT, which stands for USD Tether. This right here is USD Tether. And another example of a stablecoin is USDC here, or USD coin. All right then, so now it's time to take a look at what is a currency pair. And this right here is super important if you want to trade cryptocurrencies. Understanding currency pairs is, you know, something you can't do without. So the first thing we need to understand when it comes to crypto trading is that all cryptocurrencies are traded in a pair, which means that you always sell something to buy something else. So for example, if you live in the US, every time you go to the store, let's say you want to buy some milk, you have to sell something in order to get the milk. And if you live in the US, you sell US dollar to get the milk. So you trade US dollar to get milk. And the same thing is true for crypto. You always need to sell something to buy something else. So for example, BTC/USD basically means that you sell USD to buy Bitcoin. So as you can see, this image right here demonstrates this concept. So for example, you need to sell US dollar, you give US dollar to get Bitcoin. And right now, Bitcoin is trading at around 50,000. So right now, in order to get one Bitcoin, you need to sell $50,000. The next thing we need to understand here is base and quote currency. So the first currency in a pair is the base currency, and the second currency is what is called the quote currency. So for example, if we have BTC/USD, Bitcoin right here is the base, and USD right here is the quote currency. And now then, how can we understand these pairs? Well, a simple way to think about pairs, and this is how I think about pairs, is, for example, when you see Bitcoin/USD, you want to think about this as Bitcoin measured in US dollar. So for example, right here, we're looking at a Bitcoin USD chart. And by the way, today is the most extreme day in crypto in a very long time. The crypto market is actually crashing today. But as you can see, Bitcoin is right now trading at around $50,000. And since we are at a Bitcoin USD chart, remember how to think about this. We think about this as Bitcoin measured in US dollar is right now 50,000. But now let's take a look at another example. We can also, for example, have Bitcoin/ETH. And when we have Bitcoin/ETH, we have Bitcoin measured in Ethereum. So for example, right here, you can see that we're looking at a Bitcoin/Ethereum chart. So what this price basically tells us is how much is Bitcoin measured in Ethereum. And you can see that the number here is around 22, almost 23. So this basically means that one Bitcoin is right now worth around 23 Ethereum. So while one Bitcoin is worth $50,000, you can also measure Bitcoin in Ethereum. And right now Bitcoin is worth around 23 Ethereum. And when it comes to crypto trading, you don't have to trade Bitcoin measured in US dollar. You can also trade different pairs like Bitcoin measured in Ethereum, Bitcoin measured in US dollar Tether, or maybe Ethereum measured in Bitcoin. So now let's take a look at some common examples of cryptocurrency pairs. So we have, for example, Bitcoin measured in US dollar Tether. We will talk more about stablecoins. What is US dollar Tether? We will talk more about that very soon, and it's very important. But this is an example. Another example is Ethereum measured in US dollar Tether. A third example could be Ethereum measured in Bitcoin. And you can basically have any type of combination here, but these are some common crypto pairs. All right, so now when we know about crypto pairs, it's finally time to learn about stablecoins. And here on the right, we have a few examples of stablecoins. We have US dollar Tether that we have been talking about. We have the US dollar USDC, which is right here. And here we have another example of a stablecoin called DAI. But first and foremost, what is the definition of stablecoins? Well, you can think about stablecoins as the crypto version of a fiat currency. And fiat currencies are basically the normal type of money, for example, US dollar, euro, or here in Sweden we have the Swedish crown, the Swedish krona. So many times different countries will have different fiat currencies, and stablecoins is basically, you can think about it as a crypto version of a fiat currency. And one important thing about stablecoins is the backing. And what do we mean by this? Well, stablecoins are backed by quote unquote stable assets like, for example, the US dollar. And what do we mean by backing? Well, if a stablecoin is backed by, for example, the US dollar, the value of that stablecoin should be equal to $1 US. So basically the goal of the stablecoins is to follow a fiat currency, and most of the times this will be the US dollar, because the US dollar is basically the world fiat currency. It's the most important fiat currency in the world. The whole world pretty much depends on US dollar right now. So the goal of stablecoins is to, as closely as possible, follow the price of $1 US. So for example, right here we're looking at Tether, and you can see that the price of 1 USDT, you can look right here, this is USDT measured in dollar, and you can see that the price here should be very close to $1. You can see right now the Tether is $0.99974. But what you can see here, if you look at the chart, is that $1 is the line right here. And you can see that the price will should hover very close to this line. You can see the price, moves very close to the line. Sometimes it's below, sometimes it's above. But the goal here is that the Tether should follow or be as close as $1 as possible. But now then, what is the purpose of stablecoins? Well, we have a few different purposes here. The first purpose is to make it easier to trade crypto without having to convert your cryptocurrency to fiat. So when you have a stablecoin like Tether, instead of always having to sell your cryptocurrencies to buy fiat like US dollar, you can instead sell your cryptocurrency to buy Tether. So by using stablecoins, you can basically have something that is worth the same as $1 US without leaving the crypto system. Another purpose here is that it provides a stable value in a volatile crypto market. So as you guys know, and as you guys saw when I showed Bitcoin is down like 10% today. So having the ability to quickly exit cryptocurrencies and buy Tether is a way to be able to exit the crypto market without actually having to buy your fiat currency like US dollar or euro. And stablecoins are very useful for, trading, saving, and transferring money without having to worry about price swings. So let's say you want to sell Bitcoin and then move into something else. Instead of having to buy that thing directly and perhaps lose money to spreads or other fees, you can sell it for a stablecoin where you don't really have to worry about the price swings, which always happens in the crypto markets. And last but not least, some examples of stablecoins are USDT and USDC. So now to a very important question, and that is, are cryptocurrencies risky? And well, for this question, we can just look at the Bitcoin chart today. You can see the Bitcoin chart. Bitcoin is right now down, around 11-12%. So in that sense, cryptocurrency is very risky because it's very volatile. It can move up and down a lot and very fast. But one thing that is very great about trading cryptocurrency is that you can make money when the market is going up, but you can also make money when the price is going down. So saying that crypto is risky because it can go down a lot is not really a great argument, because if you are betting against the direction of the market, you can lose money if the price goes up fast as well. So both when the price is going up fast and going down fast can actually be risky from the perspective of a trader. So when it comes to risk, we have to talk about something called volatility. And as I already mentioned, crypto prices can fluctuate a lot in short periods of time. And this can lead to potential large gains, but it can also lead to potential large losses. So we can regard high volatility as, high risk, but at the same time, it also means that we have high potential reward. And another potential source of risk when it comes to cryptocurrencies is regulatory uncertainty. And unfortunately, this right here is something that is pretty much out of our control as traders, but laws and regulations can vary a lot between, different countries and so on and so on. So I highly recommend that you do some research on the laws in your country, because, everything from taxes to different kinds of regulations can vary a lot. So it is important that you do, before you trade crypto, that you do some basic research of, what are the laws and regulations in your country. Next, we also should mention security risks. So although rare, hacking and other types of cyber threats can occur. This right here, as I said, is very rare. And for example, Bitcoin has, never really been hacked. So there are some cryptocurrencies that are very safe, that have never been hacked. But when it comes to smaller coins and, very small altcoins and so on and so on, hacking has definitely occurred. Even, large exchanges. In some rare cases, even large cryptocurrency exchanges have been hacked and so on. You might remember FTX, which is now, bankrupt, had a very big scandal where they lost pretty much all funds. So although very rare, even exchanges do have security risks. Last but not least, I do want to mention scams and frauds. First of all, there are a lot of scammers in the crypto space. So especially, in bull markets when, lots of people are making lots of money, you will have tons of scammers trying to, in different ways, getting your cryptocurrency. It might be, for example, bots in comment sections. I know that I have been, dealing with lots of bots and scammers in my comment section. So I spend lots of time deleting comments, blocking words, doing my best to, make it so that the scammers can't even comment. But here it's very important. If you just follow one rule, you will not get scammed. And that is, you should never, ever send crypto to someone you don't know and trust. So for example, a common cryptocurrency scam is, scammers might hack YouTube channels, put up like a fake video with Elon Musk or Michael Saylor or someone, and they will say something like, send me 1 Bitcoin and I give 2 Bitcoins back. That is a very obvious scam. So if you just follow this rule to never send crypto to someone you don't know and trust, you should be good here. So to repeat, never send crypto to someone you don't know and trust. Alright then, so now you know about some crypto basics and we are finally ready to start trading here. And to trade crypto, you will need 2 platforms. First of all, you need a platform where you can analyze the charts so you can know when to buy and when to sell your cryptocurrency. And later on in this video, I will go over in a step-by-step manner how to get started with TradingView. And in my opinion, TradingView is the best platform when it comes to analyzing charts. So I will go over step by step how to get started with TradingView. I also have a link in the description and the top comment that if you plan to sign up on TradingView, make sure to use that link because you can get a 30-day free trial of their premium versions. They also have a free plan, but you will get a 30-day free trial, and you will also get a $15 bonus if you decide to sign up later on. And the second thing we need in order to trade crypto is that we need a platform where to actually buy and sell. And for this, I will show you guys a few different crypto trading platforms. And depending on what style of trading you are planning to do, some platforms might be better for you than others. So make sure to really pay attention when we go over the crypto platforms. Alright, so to trade cryptocurrency, the very first thing we need is a software where we can look at and analyze charts. And in my opinion, the best trading software out there is TradingView. I have been using TradingView for well over 5 years now, and the platform has everything you need when it comes to trading and technical analysis. First of all, as I already mentioned, the purpose of TradingView is to analyze charts to determine optimal buy and sell times for crypto. But you can of course also use TradingView to trade stocks and forex, but this course is focused on crypto trading. And TradingView is perfect for crypto trading. You can find pretty much all cryptocurrencies, all crypto charts on there. But what about the rating? What does other users and traders think about TradingView? Well, TradingView is the #1 website in the world when it comes to all things trading. It has more than 60 million users, so quite a large user base. And it also, just as a stat, it has more than 1.5 million mobile reviews with a 4.9 rating. So I'm not alone in finding lots of value in TradingView. And one of the best things about TradingView is that it has all the technical analysis tools you could ever want. So for example, TradingView has more than 400 built-in indicators and strategies and more than 100,000 public indicators. So on TradingView, different traders can build their own indicators and publish on TradingView. So there are just so many options out there. We also have some more indicators like volume profiles, auto candlestick patterns, and auto chart patterns. All of these tools are great and they do a lot of work for you. However, it's important to mention here that TradingView has a free version, and if you are completely new to trading, the free version is definitely a good way to start, in my opinion. But if you want to, you can use my link that will be both in the description and the top comment of this video, and you can use that link to get access to all TradingView features for 30 days. And what you also get is a $15 bonus if you later on decide that you want to upgrade to a paid version. For example, the auto chart pattern indicator and volume profiles here is not available on the free plan. So if you want to, definitely feel free to do the free trial. But now guys, let's take a look at how you can get started with TradingView in a step step-by-step manner. So to get started with TradingView, you want to first head over to tradingview.com. So when you first open up TradingView, it should look something like this. And the very first thing we need to do here is that we need to sign up. Because if you don't sign up, you will get this pop-up window, and when this window appears, all your analysis will be deleted. The good news is that signing up for TradingView is free and very simple. And for the sign-up process, I have actually managed to get a special link from TradingView that will be both in the top comment as well as in the top of the description. You can use this link to sign up to TradingView for free. But then if you later on decide that you want to upgrade your plan to a pro or premium version, you will get a $15 bonus towards your plan. And at the same time, I will get a small commission. Yeah, boy. So that is a great way to get benefits and help out the channel at the same time. So the best way to sign up is to use the link. But if you for some reason don't want to, you can simply go to tradingview.com and press on get started right here. So after clicking on the link, you should get a window that says you were invited to TradingView. Then you want to click on join now for free. And here you can go through a simple sign up process using Google, Facebook, email, and so on. So now I have signed up and I'm logged in to a free TradingView account. And let's start here by taking a look at the different TradingView plans. So I want to go up here to the upper right corner and press on upgrade right here. And we basically have 4 different options. We first of all have the free option, and this is what I recommend all beginners to start with. You can start off with the free option.
It's free!
I saw that.
Then if we scroll down a bit here, you can see that we have 3 different paid plans. We have the essential plan, we have the plus plan, and we have the premium plan. And if you guys want to, you can also see that you can actually try out all of these plans for 30 days for free. So if you are a complete beginner, I either recommend that you go for the free version or that you go for one of these 30-day trials. Right, okay, so now I have logged in to a free TradingView account. And this right here is the starting screen for TradingView. As you guys can see here on the starting screen, we have a few popular markets such as Bitcoin, Tesla, and Apple. You can get a sort of little overview of what's going on. We also have a few tabs here: products, community, markets, news, and so on. You get a nice little overview here. But I think that the very first thing and the very first step we need to understand is how do we open up a chart. So to open up a chart, you want to go here to the products tab and you want to press on the super charts button. And now, as you can see, we have opened up our first chart. The standard chart that tends to open is Apple. Right now, we're looking at an Apple chart, which you can see in the upper left corner. You can see it says Apple Inc. right there. And if you want to change the market, so you want to look at another market, what you simply do is that you go up here to the upper left corner, you press where it says AAPL right here, and here a window pops up and you can search for any stock, cryptocurrency, or whatever you want to trade. And here, when you want to search for something, let's for example say that you want to open up a Bitcoin chart, what you can do and what many people will do is that they want to search for Bitcoin. But if you want to find markets more effectively, what you preferably want to search for is actually something called a ticker symbol. So for example, the ticker symbol for Bitcoin is BTC. The ticker symbol is basically a few letters that are assigned to a specific market, and this will make TradingView understand better what you're actually searching for. To find the ticker symbol for a market, you can Google it. So you can, for example, Google Bitcoin ticker symbol or Google Apple ticker symbol. For example, for Apple, the ticker symbol is AAPL. So you can see if we search for AAPL, we will find Apple right away. If we want to find the Tesla, I think it's at TSLA. So you can see if we search for TSLA, we will find Tesla. But now let's open up a Bitcoin chart. So what we do is that we search for the ticker symbol. So we search for BTC. And here this can look a bit confusing because as you can see, we have many different Bitcoin markets here. And you may of course wonder, what is the difference between these charts? Well, as you can see on the right here, you can see that we have different sort of exchanges for Bitcoin. And this is simply because Bitcoin is traded on different crypto exchanges. So for example, you can see that the top here is Bitstamp. You can see that the second one here is Coinbase. Coinbase is the largest crypto exchange in the world, if I'm not wrong. As a rule of thumb, it's good to open up the market with the largest exchange. So let's open up a Bitcoin chart here, or to be more precise, let's open up Bitcoin on Coinbase. So now, as you can see, we have opened up the Bitcoin chart. So now I'm going to talk about something very important and something that will make your TradingView experience much more pleasant. And that is basically, how do we move around the chart? How do we, zoom in and zoom out and sort of navigate the chart in an effective manner. This is very important, and this is something that I remember was pretty confusing when I got started. So first of all, the very first thing you want to do is that you want to go down here to the bottom right corner, and you can see that we have a button here which says A. You want to make sure that this button is unchecked, because if we have this one checked, let me check this one, as you can see now, when we navigate the chart, it will automatically zoom in and zoom out. So if you have this button checked, you are not really free to move around the chart as you want. Some traders uses this, but most traders don't use the auto zoom button, and I recommend that you at least in the beginning, don't use this one. It's much more effective, in my opinion, to be able to zoom in and out freely. So what I'm gonna do here is that I'm gonna make sure that we have the auto button unchecked here so that we can move around freely. So now then, how do we zoom in and zoom out? Well, the most basic way is, first of all, if you want to zoom in and out, you can hold on to the right side where you can see all the prices. So you hold your left click button and you can drag down and up here to zoom in and zoom out on the vertical axis, and you can also hold your left click button on the sort of lower part where you see all the dates and such, and then you can basically zoom in and zoom out on the horizontal axis. However, in my opinion, this is not the most effective way to move around. The most effective way to move around in TradingView, in my opinion, some traders differ a bit how they do this, but this is how I do. First of all, what you can do is that if you hold your left click on your chart, you can see that you can move around the chart by just holding on to your left click. And this is how I move around. But what I also do is that I move around like this, and then I use my mouse scroll button to zoom in and out here on the horizontal axis at the same time. So this is basically how I move around the chart in a quick manner. And I also use the sort of sidebar here to zoom in and out. So this is basically how I move around quickly in TradingView. Another sort of tip or trick for you guys is, if you want to zoom in on a specific point here on the chart, let's say that I want to zoom in. Let's say that I want to zoom in right here. What you then can do is that you can hold your control button and you want to make sure that you hover your mouse over the point where you want to zoom in. So you hold control, you hover your mouse, and then you use the scroll wheel button. And as you can see, then you will zoom in to that exact point. Let's say we want to zoom in at this exact point right here. Then we hover the mouse above, we hold control, and then we basically use our mouse scroll wheel to zoom in to that specific point. So that is a quick tip that you can use, to navigate the chart a bit more easy. Now guys, let's take a look at, what about if you want to look at a chart, let's say that you want to look at a chart on a sort of very long time perspective, like for example right here. As you can see, in this case, you can see that the recent price movements take up a very large portion of the chart, while the sort of price movement from long time ago, you can't barely see it on the chart as of right now. The solution to this is to use a logarithmic scale. So what you want to do here is that you go down once again to the bottom right corner, and now you actually want to use the auto zoom, but you also want to click on this L button right here, which says logarithmic. So let's press on that one. And now, as you can see, the chart looks completely different. And that is because now the movements we couldn't even see before, now these movements are clearly visible on the chart. And what the logarithmic mode basically do is that the price movements from a long time ago will take up about as much as the recent price movements. I will not go into detail, the math behind the logarithm scale, but what it's meant to do is basically so that small movements from long time ago, you can see them much more clearly. But since most traders are focusing on the recent price, it's pretty uncommon to use the logarithm mode. So now I'm gonna uncheck the logarithm mode and I'm gonna uncheck the autofill. So let's go back here to the recent price right here. So now I'm gonna take a look at something that I get asked a lot regarding TradingView, and that is, how do I change the appearance of the chart? Many traders prefer to not use a white chart. It's very bright for the eyes, especially if you sit for long hours. It can be very annoying for the eyes, especially here in winter time. My eyes tend to get a bit dry, and staring at white screens can make it a bit worse. So now the first thing I want to show you guys is how do we change TradingView to a dark mode. The most simple way to do this is that you simply right click on the chart, you go down here to where it says color theme, and you press on dark. And now, as you can see, the background of the chart is dark, and you can also see that the sides are dark. Everything is much darker and more pleasant in my opinion. However, some users of course prefer white background. It's a purely personal preference. But also guys, many people of course want to customize their chart even further. For example, make it darker, make it brighter, or even change the colors of the actual candlesticks. And to do that, you want to make sure that you right click on the chart and you want to go here to the settings tab. Now you can see a chart settings button appear here. And if you want to change how the candlesticks look like, you go up here to the symbol tab right here. And here you can see that we have many customizable things. The first one is, the candlestick body. And as you can see, if we, for example, uncheck this one, so this is how it looks like checked. But if we uncheck this one, you can see that the candles will be sort of hollow. The middle part of the candles will disappear. Some traders actually use this kind of chart. I think it looks pretty cool. Actually very cool in my opinion. So you can do that if you want to. But what you also of course can do is that you can change the color of the chart. So the bullish candles the standard is green here, but you can change them to, for example, white if you want to. Some traders use white for the bullish candles and black for the bearish candles. Then you can change the border to black and white as well, and you can change for example, the wick to black and white. And if we press OK now, you can see that we have a pretty cool chart that looks something like this. You can basically, if we go back here to the settings tab, you can customize your own candles however you like. There are many different options here. So if I were you, I would take some time and make a chart that really looks nice to you. Then we have a few other settings here. These ones, the status lines are, in my opinion, the standard settings are good. The standard scale settings are good. Here on the canvas button, here you can change the sort of background of the chart. So this is very important. For example, right now you can see that we have a background with a gradient. But let's say that we want, a completely, for example, black background. Then we can click on solid right here and change the background to black. Now, because we have black candles, you won't be able to see the candles. Let's, for example, change to gray right here or something like that. Basically, feel free to mess around with this however you like. You can choose to, disable the sort of lines we have on the chart, right? So you can, for example, press none right here and the lines on the chart will disappear. But I will not go into too detail about the settings. I think they are pretty straightforward. But as I said before, make sure to take some time to customize your chart to exactly how you want. I can just mention, now we have messed around a lot with the chart here. So if you want to go back to the basic settings, you simply go down to this button right here and you click apply defaults. Now the chart will go back here to the basic settings, but we are on the dark mode. And if you want to change back to the light mode, you do exactly as I showed you guys before, but you press on light. But alright guys, so now let's take a look at some of the best crypto exchanges. This is where you actually buy and sell your cryptocurrency. And let's start here by taking a look at Binance. Binance is the largest crypto exchange out there when it comes to trading volume. And it actually has more than 210 million users, and the user base is just growing and growing. It also has around 65 billion average trading volume. So this is a massive and trusted exchange. Another benefit of Binance is that it's available in over 180 countries. Another good thing about Binance is that Binance offers a wide range of different cryptocurrencies. To be more precise, Binance has more than 500 different types of cryptocurrencies, and they also list new cryptocurrencies very frequently. Another good thing about Binance is that Binance has very low fees. You know, every time you buy and sell cryptocurrency, you have to trade a fee here. So it's important that the exchange you choose actually has low fees. And Binance has some pretty good fees here. The fees start at 0.1%. Which basically means that for every $1,000 traded, you pay $1. So it's not too bad. And another great thing is that the more you trade, the less you pay. So if you trade a lot, the fees will go down. And another great thing when it comes to fees here is that if you wanna use Binance and lower your fees even more, I have actually managed to get a special link here to Binance. The link will be both in the description and the top comment of this video. You can use the link to get 10% lower fees, and at the same time you would support the channel. So if you plan to use Binance, definitely make sure that you sign up using the link below. Last but not least, I can just mention that Binance has high security and it meets the required regulatory standards. The next crypto exchange we're gonna talk about here is Bybit. And if you are a new trader and are interested in getting free bonuses, then Bybit is one of the best choices. You can actually get up to $30,000 by using my link below. So step number one is to navigate down to the description or the top comment of this video. Then you want to press on this link right here. Next, you should land on this page right here where it says welcome to Bybit, and you can join me on Bybit now to unlock $30,000 here in bonuses. But of course, guys, you won't get the $30,000 just by signing up. That would be insane. Instead, you need to look at this box right here. And as you can see, the more you trade here, the more free bonuses you will get. So for example, you will get $15 for free when you trade your first $100. Next, you will get $100 for free here by trading more, and actually as you can see here, over 80% of all the users win $100 or more. And then if you trade even more, you can get 800, you can get 5,000 more, and last but not least, you can get the full $30,000 bonus. But in order to get that bonus, you need to trade a lot here. And signing up to Bybit is super simple. You can either just enter your email here, or you can use a mobile number. Before you sign up, just make sure that this code right here is correct. It should say 88512. And then when you're ready, sign up and get your welcome gifts. And yeah, as I mentioned, 80% of users will win $100 or more for free here on Bybit. And this is a reason why this is one of the best platforms when it comes to free crypto bonuses. Another great thing about Bybit here is that they are a big exchange and they also have a great support here. So they have more than 30 million users worldwide, and they have around 25 billion of average trading volume. Bybit is also available in more countries compared to Binance here. You can use Bybit in more than 230 countries, so that is a big plus here. And they also have great support. They have 24/7 customer support. And last but not least, guys, Bybit also have good fees. It's pretty similar here to Binance, where fees start at 0.1%, and it goes as low as 0.005%, but that is if you trade a lot. So if you trade a lot on Bybit, you will both get free bonuses and you will also get lower fees. Last but not least here, I just want to mention Coinbase. And while I don't really recommend Coinbase, it can be best if you are a complete beginner when it comes to crypto, because Coinbase have a very friendly interface. So it's very, very simple to use and very simple to, for example, buy your first Bitcoin or first Ethereum. It has around 200 cryptocurrencies, so it's less cryptocurrencies compared to, for example, Binance and Bybit. And one big benefit about Coinbase is that it's a big trusted platform. It's one of the largest crypto exchanges with 226 billion traded per quarter. It's available in more than 100 countries, so it's also, it's not available in as many countries as Binance and Bybit. And one of the bad things about Coinbase is that it doesn't have good fees. So remember, when it came to Binance and Bybit, we had fees starting at 0.1%. Here the fees start at 0.4 to 0.6, so it's definitely worse here. A good thing is that the fees will be lower the more you trade. But guys, if you want to sign up with Coinbase here, I do also have a link to Coinbase down below. But as I said, I would probably only recommend Coinbase if you, don't really plan to trade a lot. Perhaps you are only interested in, buying a lot of Bitcoin and holding, or buying one of the larger cryptocurrencies and holding. Then you can definitely use Coinbase if you feel like the user-friendly interface is one thing you really want. Alright guys, so now when you know about a few different crypto exchanges, now we are finally ready to take a look at how to buy and sell crypto step by step. And for this part of the course, I will be using Binance to demonstrate the process of buying and selling crypto. But the steps to buy and sell crypto on Binance will be very similar to other platforms like Bybit. So if you, for example, are interested in, taking advantage of the $30,000 Bybit bonus, what you can do is that you can simply follow along with this step-by-step tutorial, but on Bybit instead. So as I said, if you are using Bybit, you can simply follow along with this step-by-step tutorial because the steps are very similar between the platforms. But now let's dive in and take a look at how to buy and sell crypto. Alright guys, so the very first thing we need to do here is of course to create a Binance account. So first, make sure that you head over to Binance.com, and next we want to press on this button right here, sign up. And this sign up process is a little bit more complicated compared to if you, for example, sign up on Google or Instagram or whatever. And the reason for this is that you need to do a verification process where you need to prove your identity. And this is something Binance and other crypto exchanges are required to do by law, and it also improves the security of the platform. So now let's go up here to the upper right corner and press on sign up. So here, when it comes to signing up, you can either sign up using email or phone number, and you also have an option to sign up with Google or with Apple. It doesn't really matter what you choose here, so choose whatever you like. Next, you need to verify your email. So head over to the email you chose, and you should see an email that looks something like this. Next, you want to open up the email and you want to copy this activation code and copy it by pressing Ctrl+C, and then you want to go back and press Ctrl+V here. Now it's time to create a password, and here you need to use at least 8 characters, and you need to have at least one number and at least one uppercase letter. So make sure that you include all of these letters, and now press next. So now guys, your account has been created successfully and it's time to set it up. And here where it says referral ID, you want to type out this code right here. This code is my referral code for Binance. And by using this code, you will get 10% off on all your trade. And at the same time, you will also support the channel. So when you have the code typed in, you want to press next here. And now it's time for the verification process. First of all, you have to choose your country here, so you can search for your country. But since I'm from Sweden, I'm gonna use Sweden, of course. And now you can see that we need to complete a few steps here to verify our account, and this will just take around 7 minutes. And here you will need to enter some personal information, and you will also need a government issued ID. So you can use, for example, a national ID card, a passport, or any other government issued ID. You will also need to do a short liveness check to prove that you are the person on your ID. So you will basically need to take a quick selfie where you spin your head around a bit, just as how you do it when you, for example, set up your Apple Face ID. Then you will need to answer some quick questions, and you also need a proof of address. The documents that can be used as proof of address are things like utility bills, bank statements, or other government issued documents. So now let's press continue and start this process. So first you need to show your nationality here, which for me is Sweden. You need to type in your first name, your last name, and also the date of birth. Next up, it's time for the identity verification. And here you will be directed to another website to complete the steps. You will show your ID card and you will also take a selfie. You also have the option here to complete this with a mobile, and this is what I did when I set up my account. It was much easier to both scan your face and show your ID card on the phone, so I would actually recommend that you use the phone for this step, but you can also use your computer. So let's press I want to complete via mobile phone. Now you simply need to scan this QR code in the Binance app. And next up, you simply want to follow the step-by-step guide in the Binance app. Since I have already done this, I cannot show this again. But if you guys have any questions about this process, make sure to drop a comment down below and I will try to answer as fast as possible. Once you have followed all the steps in the app, your identity verification is completed and it will be under review for just about 5 minutes or so. Alright, so congratulations, you now have your Binance account set up and ready to go. To double check that you are verified, you can simply go up here to this button and it should say verified right here. But as I said, this process should be done very quickly, but I've heard that the time period here to get verified can differ a bit, so if you have any troubles, just drop a comment down below and I will try my best to help. But alright guys, so this right here is how the starting screen should look like. If you are currently not on this screen, just simply go up to the Binance icon up here and press on it, and this should take you to this page. And you can see that right here you have the most popular cryptocurrencies like Bitcoin, Ethereum, Binance Coin, and so on and so on. And if you press on this button right here, you can see the new listings here on Binance. And here at the top, you can see we have buy crypto, markets, trade, futures, earn, Square, and more. And in this tutorial, I will go over the most important ones. But all right then, so the very first question you might be asking yourself is, of course, how do I buy my first crypto? And the fastest and easiest way to buy crypto is to simply use a credit card. So to do this, we go up here to the buy crypto button. Next, we need to enter how much we want to buy, and we also need to specify what cryptocurrency we want to buy. So let's say we want to spend $100. The minimum amount here, as you can see, is 15, but let's choose $100 right here. You can see that you can change the currency you want to spend in this scroll bar right here, but let's just stick with USD. And you also need to, of course, choose what you want to receive. So right here, you can see that it says USDT. And this is basically a crypto stablecoin that tries to follow the dollar. And you can use USDT to buy other cryptocurrencies. But you can also, for example, choose to buy Bitcoin right away. And now, as you can see, if you spend $100, you will get 0.0015 or 16 Bitcoin. Next, you want to choose your payment method. And here you can either choose a card, Visa or MasterCard, and you can also use Google Pay and Apple Pay as well. But let's choose card here and click confirm. And then we want to add our card. So here you simply enter your card number, and you also need to enter the expiration date and security code. And here it's important that the name of the card is the same as the name on your Binance account. You also of course want to make sure that you enter the right information here and that the address is correct. And when you're ready, you can simply press confirm. The good thing about using a credit card is that it goes pretty quickly. It usually takes a few minutes to perhaps an hour. However, the downside with using a credit card is that the fees are usually pretty high. Another downside with this method is that many credit cards has limits, so if you need to buy very large amounts, this method may not be for you. Another method to buy crypto is to use a bank transfer. And the great thing about this method is that the fees are much smaller. And to do a bank transfer, we want to head over here to the deposit tab. And here, first of all, you can see that you need to select the currency you want to use. Since I'm living in Europe, I usually just do euros here. And here, since I'm from Europe, I'm going to use the SEPA bank transfer. And you can see here that the fee is only €1, so it's very cheap. And the estimated time here is 0 to 2 business days. So it takes a little bit longer compared to the credit card, but at the same time, the fees are much lower. So if you're gonna do a large deposit, this method is definitely recommended. It's also worth noting here that if you are from another region, you will probably have different options here. If I'm not wrong, this is only for Europe. So depending on where you live, the processing might take longer, but now we are ready to press continue here. Next up, we need to enter the amount. So let's say here that we want to transfer €10,000. I think 20,000 is the limit here. You can see 2 to 20,000. Let's choose 10,000 here and press continue. And here, and this is very important, as you can see, your bank account name must match your name registered to your Binance account, and Swift transfers are not supported. And right here is all the necessary details to complete the transfer. You will need to copy your account name, the IBAN number, the BIC, the bank name, and the address. Then you simply need to log in to your own online banking platform. Then you choose the option to make a bank transfer. And then you need to enter all of these details and make sure that everything you enter here is correct. After you have double checked that the information is correct, you're ready to make the bank transfer. And you should receive the money in a few business days. When the money has arrived in your Binance account, you will get an email and a notification, and you are ready to start trading. All right, so now when you have some money in your account, whether you used a credit card or a bank transfer, now we are ready to start trading crypto. But before we do this, let's actually take a look at where our money or where our cryptocurrency is. So what we want to do is that we want to head up to this button right here, and we want to press on assets. And right here is an overview of all our cryptocurrencies. And as you can see, when you first open up this page, you can see that all of the information here will be hidden. So to unhide this information, you simply press on the I right here. And you can see that my estimated balance right now is $182, or in other words, 0.0029 Bitcoin. And for me, since I live in Sweden, the taxes for cryptocurrencies is very bad. So for tax reasons, I actually do my cryptocurrency trading on another platform called Avanza, but it's only available in Sweden. But if you scroll down a bit here, you can see my assets right here. And you can see that I currently have some euro. I have a total of 171 pretty much euro, or in other words, that's equal to $182. And I also have a tiny amount of Bitcoin. You can also see that on the bottom of this page, we have some recent transactions. You can, for example, see that I transferred over some Bitcoin to my Binance, just around this amount. And I later on converted that to euro. But yeah, this right here is the place where you get an overview of all your assets, whether it's crypto or cash. All right, guys, so now we are finally ready here to start trading crypto on Binance. And let's start here by taking a look at the easiest way to trade crypto. To do this, we want to head up here to the trade button, and we want to navigate down here where it says convert and block trade. The easiest way to trade at all sizes. And to trade here, we need to enter what we want to convert from and what we want to convert to. So remember, right now I'm having some euros in my account. So to change the currency we want to use here, we simply press on this button right here. And as you guys can see, I currently have 170 euros and I want to use my euro to convert it to a crypto. So let's choose euro right here. Next, we need to type in the amount and let's use all of it right here. So let's type in 170. And let's say I want to buy Bitcoin. You can see the standard here is Bitcoin. But if you want to convert it to another cryptocurrency, you simply press on this button right here and you can search for your crypto. You can, for example, search for Ethereum or XRP or whatever crypto you want. But now let's say I want to buy Bitcoin. So I'm going to convert 170 euros to 0.00298 Bitcoin. Next, we want to click this preview conversion right here, and you can see that you have a few seconds here to press on convert in order to get this exact price. And the reason we have a timer here is of course because the market is moving all the time. So Binance can only guarantee a price for a certain amount of seconds. So you can see that when this timer resets, the amount of Bitcoin you get will also be a little bit different. But now let's press convert for this price right here. And as you can see, the conversion was successful. And to double check that we now have Bitcoin in our account, we can go to our wallet here. Let's once again uncheck this button, which hides all the balance. And you can now see that we have in our account 0.00297 Bitcoin. But now let's actually go back here to convert and block trade, because what you also can do is that you can, for example, convert one crypto to another crypto. So let's say now that we want to, for example, buy Ethereum instead. And now we have Bitcoin in our account. So what we now want to do is that we want to use Bitcoin. So we choose Bitcoin here and let's enter the amount. So let's enter 0.00297 here. So we basically use all our Bitcoin and we want to convert it to Ethereum. So to choose Ethereum, we click on this button. We simply search for ETH. ETH is the ticker symbol for Ethereum. And by the way, when searching for cryptocurrencies, the easiest way to find them is to search for the ticker symbol. And if you don't know the ticker symbol of your cryptocurrency, you can simply Google ticker symbol for that cryptocurrency. But now let's go ahead here and choose Ethereum. So as you can see, we will convert 0.00297 Bitcoin and we will get 0.0527 Ethereum. So to convert this, we once again click preview conversion. We have a few seconds to guarantee the price and we press convert. Here we got an error code. Perhaps we were a bit too slow here. So let's redo this conversion, and as you can see, this was successful. We transferred this many Bitcoin into Ethereum. And once again, to double check that we have Ethereum in our account, we can go here, and as you can see, now we have 0.0527 Ethereum in our wallet. Last but not least, let's actually convert back the Ethereum here to cash. So what we simply do is that we choose Ethereum, the amount we want to convert, and let's actually convert it back here to euro. So once again, we preview the conversion and we press on convert right here. And by the way, what I'm doing right now, converting back and forth between different cryptocurrencies with no reason, is definitely not recommended. Because every time you buy and sell a cryptocurrency, even though there's no direct fees, you will actually lose a little bit of money because of something called spread. And the spread is basically the difference between the price the sellers are willing to sell and the price the buyers are willing to buy. So when you buy back and forth, you will actually lose a little bit of money. But I'm of course just doing this to show you guys how it works. Alright then, so now we are ready to take a look at the Binance crypto trading platform. And to open the trading platform, you want to go up here to trade. And you can see that we have different options here. We have the spot market. You can also also trade with margin. But especially for beginners, I actually don't recommend trading with margin, because margin trading basically means that you can get potential higher profits, but at the same time, your losses can get much bigger as well. So for beginners, I recommend using the spot market. And the spot market is basically the market where you buy and sell real cryptocurrencies. So you buy and sell real Bitcoin or real Ethereum. So let's go ahead here and open up the spot trading platform. And when you first open up the Binance trading platform, it can feel really overwhelming, but don't worry, I will go over everything you need to know here in a step-by-step manner. So first of all, up here in the upper left corner, you can see the market we're currently looking on. And you can see that it says BTC/USDT. And the first letter combination tells us what market we're currently looking at. And BTC stands for Bitcoin. So we are currently looking at a Bitcoin chart. The next letter combination is what this market is measured in. So right now we're looking at Bitcoin measured in USDT. If you look here to the right, you can see the current price of Bitcoin, which is 60,966. So right now, one Bitcoin is worth 60,960 USDT. You can also see the price right here. You can see currently we're trading at around 60,930. And as you can see, the price is moving up and down all the time. Right here, you can see the change in the last 24 hours. So as you can see, during the last 24 hours, Bitcoin has dropped around 1.28%. Right here, you can see the highest point during the last 24 hours. So you can see that the highest point was at 62,225. And here you can see the lowest point. So the lowest point was 60,750. So as you can see right now, Bitcoin is actually pretty close to the lowest point. You can also see the volume here. So around 20,000 Bitcoins has been traded during the last 24 hours. And you can also see the volume measured in USDT. And now let's switch the attention here and take a look at the chart. So right here, we have a price chart of Bitcoin, or in other words, we have a candlestick chart of Bitcoin. To zoom in on this chart, you can use your mouse scroll wheel like this. And you can change the vertical axis here by holding and left clicking, and you can drag around the chart here by holding your left click. And every candlestick here on the chart represents the price movement. And in this case, every single candlestick represents one day. How do I know this? Well, if you take a look up here, you can see that we have something called time frames. And right now you can see that it says 1D right here, and that stands for 1 day. But you can also change the time frame of the chart. So let's say that you want every candlestick to represent 1 hour instead. Then you basically click on this 1H button right here. And now on the chart, every candlestick will represent 1 hour. Reading the candlesticks are pretty straightforward. Green candles, like right here, represents that the price has been going up. And remember, we are on a 1 hour time frame, so it means that the Bitcoin price have been going up during that 1 hour. While red candles represent that the price has fallen during that hour or the time frame you're using. So for a green candle, the price starts right here, and at the end of the hour, the price was right here. We say that the price opened down there and closed down there. But we also have something called wicks. You can see this right here is a lower wick, and this right here is an upper wick. The wicks tell us the lowest point the price has been during that time period, in this case 1 hour, and the highest point the price has been during that time period. The opposite is true for the red candle. So for example, for this red candle right here, the price started here. During the candle, it reached a highest point all the way up here, a lowest point all the way down here, and the candle closed right here. So you can see that the next candle after this red candle opens where the red candle closed. Alright, so now when you know a little bit of time frames and how to read the chart, now let's actually switch the attention and focus on this part right here. This right here is what we call an order book, and the red numbers here are different sell orders that are currently on the market, while the green numbers here are buy orders that are currently on the market. And these orders changes every second because people are always trading Bitcoin. This is a very large market, but you can, for example, see that right now someone is trying to buy around 12 Bitcoin for 60,840, while at the same time, people are trying to sell a lot of Bitcoin for 60,833. I will later on in this video show you guys how you can put an order in the order book. And right here, you can see the most recent trades here. So you can see that Bitcoin is being traded all the time. The green numbers are when people are buying and for what price. And the red numbers are when people are selling and for what price. Now, let's take a look at something very important. And that is, how do we find the cryptocurrencies we want to trade? Well, to do this, we simply have to look at this part right here. To search for a market, you basically click search right here. And remember, the easiest way to find your market is to use the ticker symbol. So let's, for example, say that we want to find another Bitcoin market, and the ticker symbol for Bitcoin is BTC. Once again, if you don't know the ticker symbol, just Google your crypto and then ticker symbol, and you will find it very quickly. But let's say, for example, that we want to trade, instead of Bitcoin measured in USDT, we maybe want to trade Bitcoin measured in euro. So what we search for is BTC/euro, and we simply press on this market right here. So now, as you can see, the new market is Bitcoin measured in euro. And the first thing you can notice is that the price is a little bit different. And that is because euro is currently worth more than USDT. So the value here measured in euro will be a little bit lower. But let's say you want to find another market. Maybe you want to trade Ethereum instead. Then once again, you search for Ethereum, which the ticker symbol is ETH. And let's say we want to trade Ethereum measured in euro. Then we simply search for Ethereum/euro here, and we press on this market. And just like that, we are on the Ethereum measured in euro chart. And you can see that currently one Ethereum is worth around 3,172 euro. So now when you know how to find the right markets, we are ready to take a look at the different ways you can buy and sell crypto, or in other words, the different order types. So now let's focus on this part right here. And let's start here by taking a look at the easiest order type, and that is the market order. To place a market order, you simply want to press on market right here. And what a market order does is that it allows you to buy or sell at the current market price. And as you can see, currently we have some euro in our account. And let's say that we want to use this money to buy Ethereum. To do this, you can either type in how much you want to buy. So for example, you might want to buy for 100 euro. But what you also can do is that you can use this slider right here and decide how much of your current balance you want to buy Ethereum for. So let's say that we want to use all our euro here to buy Ethereum. Then we simply put the slider at 100% and we click on buy ETH. So now this trade was successful, and to double check this, we can scroll down a bit here and we can click on trade history. And as you guys can see, just recently we bought Ethereum, and this order actually got split into two types. So we had two different prices here, 3,175.44 and 3,175.90. You can see the amount we bought right here. You can see the fee we had to pay for the transaction. And once again, Binance will always take a small fee when you are trading. But now we have Ethereum in our account. To just show you guys, we can also, let's say we want to sell the Ethereum we just recently bought. We can simply choose 100%. So we want to sell all our Ethereum to the current market price. And let's press sell ETH right here. And just like that, our order is executed, and we can double check the order by going down here. And here you can see that we sold the Ethereum for slightly lower than what we bought it for. So we lost some money, and we also lost some fees. So I'm losing a bit here. Not good, not good. But now guys, we're ready to take a look at the limit order. And to do this, I actually want to change back the market here to, Bitcoin, measured in euro because this market is a bit more active. And once again, we want to focus on this part right here. And now to use a limit order, you want to simply go and press on limit right here. A limit order allows you to place a trade at any level in the market. So instead of buying, Bitcoin at the current market price, you can place a limit order. So if or when the market reaches that point, we will automatically, buy or sell Bitcoin. So for example, right now, Bitcoin is trading at around 56,770. But let's say that according to our analysis, we want to buy Bitcoin at a lower price, at 56,000. So to place this order, what we basically have to do is that we have to enter the price where we want to buy. So we enter 56,000 euro right here. We also want to enter the amount we want to buy for, and to keep it simple, let's say that we want to use all our euro. So we take the slider to 100 and then we simply press buy Bitcoin. And now, because this is a limit order, the order will not get executed right away. Right now, our order is actually in the order book. So it's only if or when Bitcoin reaches 56,000, our order will be successful. So to check this, we can actually scroll down here and you can go here to open orders. Right here, you can see all of the orders that you currently have open in the market, or in other words, the orders that are currently in the order book. So here you can see the price is 56,000 and this is the amount. And if this order gets filled, you will get a notification and it will also be visible here in your order history. If you want to close the order, you simply go to this one right here and press on cancel. And the sell limit order works in the exact same manner. And when it comes to sell limit orders, you place the order above the current price. And if the price reaches that point, you will automatically lock in profit. So now, last but definitely not least, let's take a look at the stop limit order. And to place a stop limit, you basically go here to where it says stop limit right here. And you can think about the stop limit order as the opposite of the limit order. So when you place a buy stop limit order, what you basically do is that you choose a level above the current price. And if or when the price reaches that point, you will buy the cryptocurrency. And this can feel a little bit counterintuitive because you might think, isn't it better to get the crypto at a cheaper price? But well, this is not always true, because when people do their technical analysis, by the way, we will talk more about that later on in this video. But when people do their technical analysis, sometimes they want to wait for example, certain levels to be broken before they enter the trade. And in these cases, a stop limit order can be very useful. So to place a stop limit order, the first thing you need to enter is the stop. And the stop is the level where your order will get triggered. So for example, right now Bitcoin is trading at 56,700, around there. But let's say that we have done our analysis and we want to buy Bitcoin only if it reaches 57,000. So what we basically do here is that we enter 57,000 as our stop level. This is the level where the order gets triggered. The next point right here is the limit. And the limit is basically the max amount we are willing to pay. And the limit here must be above the stop level. So let's choose 57,100 here. So this means that when the price reaches 57,000, we will buy Bitcoin, but not for more than 57,100. Last but not least, we enter the amount. Let's say once again, to keep it simple, that we want to use all our money. And then we place the order right here. You will get an order confirmation and let's press continue. And once again, since Bitcoin has not reached 57,000 yet, our order will not have been executed yet. So you can see the order here at open orders. You can see here the trigger conditions. So if the price is equal to or above 57,000, the order will get triggered and it will be bought for 57,100 or less. And once again, to cancel the order, you simply press cancel right here. The sell stop limit right here is the exact same thing, but the opposite. So this is where you automatically sell something is if the price reaches a certain point. All right, so at this point in the course, you should be signed up for TradingView and you should be signed up for one of the crypto exchanges I talked about. When you are signed up for TradingView and you have your crypto exchange ready to trade, we are finally ready to start talking about technical analysis. And first things first, what is technical analysis? Well, in simple terms, technical analysis is the study of past price movements to predict future price movements. And in order to do this, technical traders use different kinds of tools and techniques. For example, we use charts, which are basically visual representations of price over time. Charts, or more specifically, candlestick charts, are the foundation of all technical analysis. Technical traders also use indicators, which are basically mathematical calculations based on historical price data. Technical traders also use patterns, and we will talk about some patterns later on. Patterns are basically specific shapes and patterns we can see in the price movements that we can use to identify buy and sell signals. And one key aspect here about technical analysis is that technical analysis is not limited to cryptocurrencies. So even though this course right here is focused on crypto, you can also use technical analysis for other assets, like for example forex, stock trading. You can trade gold. You can pretty much use technical analysis on anything where you have a price chart. Technical analysis is all about analyzing price charts, so you can use technical analysis on different kinds of asset types. So now when we talk about technical analysis, I will actually include examples from crypto, but I will also use examples from forex and stock charts as well. And this is because, as I said, we can apply technical analysis to crypto, but we can also apply it to other asset types as well. Right, so what you can see on the screen right here is called a candlestick chart. And we are currently looking at Bitcoin, and we are on a daily time frame, meaning that every candlestick you can see on this chart represents one day. But let's actually go down here and switch to the Tesla stock chart. So now we're looking at Tesla, and we can switch once again. Let's go to the USD Euro chart. So right here, we're looking at the US dollar measured in euro. But what is the common theme of all of these charts? Well, one thing is that they were all daily charts, so all of the candlesticks represents one day. But the other common theme was that all of these charts were candlestick charts. And that is because candlesticks is the heart and foundation of all technical analysis. And before we can start analyze these charts and look at the big picture to find trends, buy and sell signals, apply indicators, and so on, we first need to understand how to read and interpret a single candlestick. So let's go ahead and do that now. Alright, so first of all, we have two different kinds of candles. We have a green candle, also known as a bullish candle, and we also have a red candle, also known as a bearish candle. And a green candle simply tells us that the price have been going up during the candle, and a red candle simply means that the price has been going down during the candle. And here, and this is very important, every single candlestick can represent different time frames. So for example, remember from earlier, we looked at a Bitcoin daily chart, which means that every single candlestick represents one day. But a candlestick can also represent, for example, 1 hour, or it could, for example, represent 5 minutes. Some traders specialize on trading on the daily time frame, while some traders are much better on the 5-minute time frame. To change the time frame in TradingView, by the way, if you haven't gotten started with TradingView yet, I have a special link that will be both in the top comment and the description. But to change the time frame in TradingView, you basically click on this button, and as you can see, we have tons of different time frames. Some of my favorite time frames are the 4 hour, 1 hour, and 15 minutes. So let's say we want to change to the 1 hour time frame. We simply click there. And if we, let's say, want to change to the 5-minute time frame, we simply press on 5 minutes right here. So now every candlestick on the chart represents 5 minutes. But now, every candlestick consists of 3 different parts. First of all, we have the body, and the body is the wide part of the candles. Next, we have something called the upper wick, and the upper wick are the small lines here, which is above the body of the candle. And last but not least, we have the lower wick, which are the lines here that are below the body of the candles. And we also have something called open, low, close, and high. And the open is basically where the price starts. So let's say that right now we're looking at 1 hour candles. And let's say that the open here is at 3 p.m. or 15. This means that the open is where the price is at 3 p.m. And the low here is the lowest point the price reached during this hour. So maybe the price moved something like this in the beginning of the hour. Then we have the high, and the high is all the way up here. The high is basically the highest point the price reached during this hour, and the close is where the price was at the end of the hour, or in other words, at 4 p.m. And the same thing is true, but the opposite for the red candle. So this candle opens right here. Let's say that this was at 12. It reached a highest point all the way up here, a lowest point all the way down here. But before the hour was over, the price bounced here. So at 1, the price was right here. So let's take a look at a real life example super quick here. Right now we're looking at Bitcoin on the 5-minute time frame, but let's change the time frame here to 1 hour. And as we can see, we are currently on a red candle. And right now it's 14:18 for me. So this candle started right here. So at 2 o'clock, the price was right here. During this hour, Bitcoin reached a highest point all the way up here. And you can see that right now, Bitcoin is trading near the lowest point during this hour. And what you also can see is that the price is of course moving all the time. You can see the price is moving up and down. And you can also see the timer right here where it says 40:16, 40:15. That means that we have 40 minutes to go before this candle closes and the next candle starts. But alright guys, so now when we have a solid understanding of how to read single candlesticks, we are now finally ready to start putting multiple candlesticks together and analyze the chart as a whole. And this is when the magic really starts to happen. But now, in order to become a successful trader, one of the most important things we need to be able to understand is if the market is trending up or if the market is trending down. Because if we can trade in the same direction as the market, we have a higher likelihood of placing successful trades. And as a result of this, we also have a higher likelihood of being profitable on a consistent basis. Alright, so right now we're looking at a gold chart on the daily time frame. And when you look at this chart, would you say that the price is in an uptrend, downtrend, or that we are in no trend at all? Well, it's pretty easy to say, duh, the price is obviously going up here, so we have to be in an uptrend. And if you guessed that this was an uptrend, you were actually correct. But we are not in an uptrend simply because the price is going up. Because in order to have a real uptrend, the price needs to follow some specific rules. The first rule the price needs to follow is that in order to have an uptrend, we need to print consecutive higher highs and higher lows. So here we have a low, here we have a high, here we have a low, here we have yet another higher high, and so on and so on. So here we have a high, and here we have a low. Here we have a higher high, here we have a higher low. Higher high, higher low. And this right here is a bit hard to see, but you can see that right here we actually printed another higher high. So as long as the price is printing higher highs and higher lows, we are in an uptrend. And when we have a perfect trend that looks something like this, it's very easy to see the highs and the lows. We can clearly see that we have a high, low, we have a higher high, we have a higher low, and so on and so on. But when it comes to real markets, it's pretty much never this simple. real markets often behaves in a much more complex manner. A real market may move something like this. We see a move up, then the price might do, something like this. We see another move up like this, and then the market might move something like this. When you look at this situation right here, it's not as easy anymore to determine what kind of trend we are in, right? So here we need some rules. We need some objective, or in other words, some mechanical step-by-step rules we can follow to determine if the trend is in an uptrend or a downtrend. And to do this, we need to learn about something called impulsive moves and pullbacks. An impulsive move is a move like right here. It's basically a move that goes in the same direction as the trend, while a move that goes in the opposite direction is called a pullback. So this right here is yet another impulsive move. This right here is a pullback. This right here is an impulsive move, and so on and so on. So to analyze this trend, it's first important to identify the impulsive moves and the pullbacks. So for example, right here, is this an impulsive move or a pullback? Well, this is an impulsive move. Then this whole move right here is our pullback. We see the next impulsive move right here, and then we see a pullback, right? A pullback. And then we have the next strong impulsive move. And the rule we need to follow here is that when an impulsive move breaks the previous high in the uptrend, so this right here is a high, and you can see that this high is broken at this point. When we break this high, this trend will still be in an uptrend as long as we are above the low of the pullback. So as you can see from this high, the price pulled back, but we did not fall below the recent low of the uptrend. So we are still in an uptrend here. And when the price eventually broke this high, right, we will still be in an uptrend as long as we maintain this low. So we are basically still in an uptrend as long as we can maintain the lows. So now let's take a look at the downtrend example. Hopefully you can see that the price right here is in a downtrend because we have an impulsive move, we have a pullback, we create a lower low, right? And then we create a lower high, and then yet another lower low. But once again, in real markets, it might look more complicated. Maybe we have something that looks more like this, perhaps something like this, right? But remember the rule here, when we break to a lower low, like we did right here, as long as the price maintains, now we're looking at the highs, as long as the price maintains this high, we are still in a downtrend. Once again, when the next low is broken right here, as long as we maintain this high, we are still in a downtrend. When the next low gets broken right here, as long as we maintain this high, we are still in a downtrend. So now I want you guys to think, where on this chart is this trend no longer in a downtrend? If you want to, feel free to pause the video and do the exercise. Well, let's analyze this chart together. So the price breaks to a new low right here, right? So as long as we maintain this high, we are in a downtrend. And when does the price breaks to yet another low? We can see that right here, the price breaks to yet another low. So in order to maintain the downtrend, we need to hold this level right here. And here you can see something very interesting. When the price pushed below this high, we saw a very strong candle. Was this a coincidence or not? Well, I can't tell you for certain, but what I can tell you is that at this point, the price broke above the high we need to hold according to my rules. And now, at least according to me, we are no longer in a downtrend. Alright, so at this point in the course, we already know quite a bit. We know how to read and understand candlesticks, and we also have objective rules to determine if we are in an uptrend or downtrend. These two skills are very important, but it is when we combine these skills together with a concept called support and resistance, we can really start finding high probability trading opportunities. So now it's time to go over one of the most powerful concepts in technical analysis, and that is support and resistance. But guys, if you have found any kind of help or value in this course so far, I would really appreciate if you can show that by dropping a like on the video. But now then, what is support and resistance? Well, support is basically a price level, or to be more precise, a price area where a stock or cryptocurrency or forex tends to find buying pressure and bounce. A support level acts as a floor and supports the price, and hence the name support level. A resistance is pretty much the opposite. Resistance is a price level or area where a stock or other asset tends to find selling pressure and as a result fall. It acts as a ceiling for the price and provides resistance and preventing the price from rising further. So let's quickly take a look at the chart right here. Here we have a clear example of support and resistance. We can see here that every time the price reached this support area, we found buying pressure and the price bounced. And conversely, when the price reached the resistance area, we found selling pressure and the price fell. And so far, this is just the basics, but we are very soon going to take a look at how we can combine support and resistance with trending markets to build a trading strategy. But before we do that, we have to learn about a very important principle. Let's take a look at this chart right here. We can see that every time the price reached this gray area, we found buying pressure, indicating that this is a support area. However, eventually, the support area broke and we saw a massive move to the downside. And before this break, we actually saw multiple signs indicating that the support level was getting weaker and weaker. And we will talk more about these signs later on in the course. But what you can see here is that after the price broke the support, the price eventually came back up to the previous support level. We saw resistance and then the price collapsed to the downside. And this right here is a very important principle. When the price falls below a support level, the same level can later flip and act as resistance in the future. This is exactly what happened in this example. And the opposite is of course also true. So if we have a resistance level and the price breaks resistance, the resistance can later on flip and act as support. And now you may of course wonder, why does this happen? Well, in this course, we're not going to dive deep into the psychology behind support and resistance, but a simple explanation here is that this can happen because traders and investors remembers the level, and they also potentially have trading orders around the level. So remember here that candlestick charts are not just random rectangles on a screen. Candlestick charts tells us a story about how buyers and sellers have been trading in the past. And as we can see on the support level, we have been seeing lots of buying pressure coming in multiple times, meaning that many people have bought around this level. So when the price broke below this level, this means that the buyers that bought here are now in a loss. So when the price eventually recovers, that means that the traders that bought on the support are no longer in a loss, and many traders will see this as an opportunity to sell at break even, and this leads to selling pressure. And another reason that can lead to even more selling pressure is that traders knows about this principle. It can act as a self-fulfilling prophecy when traders enter short positions at this level, expecting the price to reverse. And when you enter a short position, this actually leads to even more selling pressure. So now when we have a basic understanding of support and resistance, and we also know about the rules to determine what kind of trending market we are in, now we can finally put these two concepts together and build a trading strategy. So first of all, what kind of trend are we looking at right here? Well, we are looking at an uptrend, right? And why is this an uptrend? Well, we can see here that we are in a market that prints consecutive higher highs, while at the same time we are maintaining the lows. Here it can be a bit hard to see, but if you look closely, you can actually see that this low is lower compared to this low. And remember, we are still in an uptrend as long as we are maintaining the lows. So it's only if the price falls below this level right here, we are no longer in an uptrend. And one of the best ways to use support and resistance in uptrends is to look out for the resistance that the price needs to break in order to create a new high. We want to look out for this resistance to, in the future, flip and become support. So as you can see, this right here is previous resistance. When the resistance breaks, we look out for this resistance to flip and become support. This moment right here can many times act as a great buying opportunity. However, and this is very important, to make this an even better buy signal, we can combine this strategy with, for example, indicators, and we will talk about some of my favorite indicators to combine with this strategy very soon, but we can also combine this strategy with candlestick patterns. And of course, we will also talk about that later on in this video. And last but not least, we can also combine this with chart patterns. And here, I'm not saying that you have to use indicators, candlestick pattern, and chart patterns for every single trade, but the more confluences we have at the same time, the better. And let me show you why it's important to have confirmation signals. If we take a look at this next break of the high, you can see we broke the high right here. So now we are looking out for this resistance to flip and become support. So you can see that right here we had another potential buying opportunity. But in this case, the price broke in the opposite direction, and this would have led to a losing trade. And here it's very possible that we did not have any of the confirmations we talked about recently, which made this trade more likely to fail. Let's also quickly take a look at the downtrend. We can see that we are in a downtrend right here because this trend is printing lower highs and lower lows. And what we're looking out for now is that we're looking out for support that comes from a low to flip and become resistance. And here we can look out for shorting opportunities. When you short, you bet that the market will go down, so you make money when the price falls. And this right here is one beautiful thing about trading. We as traders can profit from the market going up, but we can also make a profit from the market going down. So we as traders don't have to care if we are in a bull market or bear market. We can always find trading opportunities. Alright, so now let's take a look at this trading strategy in a real market. We are currently on the 4-hour time frame on the US dollar euro chart. And as we can see, the price pushed up right here, printed a high. So this right here is our impulsive move. Then the price pulled back. We saw another impulsive move and then another pullback. And where did this pullback go to? Well, if we use our strategy and draw out our resistance level, we can see that this high that previously acted as resistance flipped to become support here in the future. So this right here is a moment where we can look out for a buying opportunity. And as I said, later on in the course, we will take a look at exactly what to look out for. But this right here is the foundation of the strategy. Once again, we can look out for the next move. We can see that eventually we saw another impulsive move. And now remember, as long as we're holding this level, the price is still in an uptrend. Eventually, as price usually does, we saw a pullback. And if we take a look here, we can see that the price actually pulled back to the previous high, right? So here we can look out for yet another buying opportunity. Once again, the price went higher, printed a high, pulled back, printed a new high, pulled back, continued, and so on and so on. And we can actually see that even in the next pullback, the price pulled back right to the previous resistance that flipped to become support. However, here it's very important to just notice that this will not always work. If we, for example, take a look at the next high, you can see that the price actually pushed below, right? You can see that here the price quickly dipped below the previous resistance. But what we still have to have in mind is that even though the price dipped below that point, we are still, remember, we are still in an uptrend as long as we are maintaining this low right here. Alright, so now if you have made it this far into the course, I hope you are starting to see how it's all coming together. We learned to read candles, we learned to identify trends, and now we know about how to use support and resistance to find buying opportunities in the market. And now, in the next chapter, we're gonna take a look at how to know when to buy and when to sell. And to help us with that, we're gonna use indicators. Using indicators correctly can be pretty hard, especially when you are new to trading. And that is because many new traders dive straight into indicators before having the knowledge of, for example, trends and support and resistance. But since you have been watching the chapters from earlier in this course, you will be able to apply the indicators in a productive and correct manner. And now, before we take a look at what indicators to use and how to use them correctly, let's just quickly go over what indicators are and why they can be useful. So, first of all, what is a trading indicator? Well, in simple terms, an indicator is a tool that applies mathematical calculations to historical prices. Indicators can also use, for example, volume and other market data, but most indicators base its calculations on the price. And what is the purpose of a trading indicator? Well, first and foremost, we use trading indicators to simplify and improve our understanding of what the price is doing. And here, a very common mistake, especially for beginners, is to simply apply too many indicators to your chart. If your chart looks like this example right here, it can often make the chart harder to understand and harder to read. And that's the opposite of what we want to do. We want the indicators to help us better understand the charts, not the opposite. The second purpose here is that indicators can give us mechanical rules that can help us to know when to buy and when to sell. And that is because mathematics don't lie. So now, the first indicator I want to talk about is the RSI indicator. And to be more specific, we're gonna take a look at how we can use the RSI together with trends and the support and resistance strategy we learned earlier in this course. But first, let's take a look at some basics of the RSI indicator. The first thing we need to know is that the RSI is a momentum indicator. And momentum basically means the speed and direction of a price movement. So, right here is an example of different kinds of momentum. When we see sharp and fast movements like we see right here, we call this strong momentum. And since the price is going up, we call this strong bullish momentum. And when we see slow and flat price movements, like for example right here, we call this weak momentum. And in this particular case, we call it weak bearish momentum because the price is going down. But how does the RSI indicator work? Well, as you already know, the RSI measures momentum, but it measures momentum on a scale from 0 to 100. So right here, we have an example of the RSI indicator. And as you can see here, most of the time, the RSI will be in between 70 and 30. But the theoretical highest point it can reach is 100, although it never really reaches 100. Sometimes it can go up to like 95, but it never really touches 100. And the same thing is true for the lower range here. The RSI can theoretically reach 0 here as the lowest value, but it never really drops down to 0. It might touch 5 when the price is extremely oversold, but most of the times it will oscillate between 30 and 70. For example, right here you can see that the RSI reached just above 80 as the highest point, and we reached maybe 25 here as the lowest point. So just to repeat, most of the time the RSI moves between 30 and 70, and 0 is the highest possible bearish momentum, while 100 is the highest possible bullish momentum. Alright, so now we're back here on the same chart as before, and to open up the RSI indicator, you want to navigate up here to the Indicators tab in TradingView. I have a few indicators starred here, but let's unstar these ones. And what we simply want to search for is that we want to search for RSI. We do have multiple different variations here of the RSI indicator, but for this video, we want to open up the one called Relative Strength. So we want to click on this one right here. Next, we want to go down here to the Settings tab for the RSI. We can keep this one at 14 as it is. This basically means that the RSI uses 14 candles to make its calculations. But I want to head over here to the Style tab, and I want to make sure to uncheck the RSI based moving average. That is a moving average of the RSI itself, not the actual price. And to make the RSI easier to read, I'm gonna take away the RSI background fill And I also like to make my RSI black and also make it a bit more thicker so you clearly can see. Now we're ready to go down here and press OK. And remember, in this course, we have been focusing on trend continuation trades, meaning that we have been focusing on trading in the same direction as the price. And when it comes to trend continuation, what I'm looking out for on the RSI is something called hidden divergence. And since we are in an uptrend, what we're looking out for is hidden bullish divergence. And what is a hidden bullish divergence? Well, what we essentially want to look out for here is, first of all, we want the price to print higher lows. Remember, we're trading in the same direction as the trend, so we want the price to print higher lows. So this right here is the price. But at the same time, we want the RSI here to print lower lows. So here we have one low and then a lower low. So as you can see, in this case, the price goes in one direction, the RSI goes in the other direction. This is why we call it a divergence. And a hidden bullish divergence indicates continuation here towards the upside. So now if you want to, you can try to find a hidden bullish divergence on this chart. So feel free to pause the video right now. Did you find it? Well, let's take a look here together. If we take a look at this low right here and this low right here, we can clearly see here that the price is printing a higher low. But if we switch the attention down to the RSI, we can see that we have the corresponding low on the RSI is right here, and the corresponding low for the higher low is down here. So in this case, we can actually see that we have lower lows on the RSI. And when we have higher lows on the price, lower lows on the oscillator, this is a hidden bullish divergence and indicates continuation. And what is important here is that we don't really want to use the hidden bullish divergence on its own. But remember here, let me actually delete all the drawings. Remember here from earlier in this video, we have already identified that we flipped this previous resistance to become support. So now things are starting to come together. For example, in this point right here, we currently have sort of three bullish things happening at the same time. First of all, we have a higher low. The second bullish variable is that we are at a previous resistance that flipped to become support. And now we also have a hidden bullish divergence. So now we have three things happening at the same time, and that can many times be enough to justify a trade. Later on in this video, we will take a look at even more signals that you can use. But for now, let's say that we want to buy on this trading opportunity. So we use a long position right here. And where do we enter? We could enter right here because this is what we call a piercing pattern. It's basically when the green candle closes above the 50% mark of the red candle, and later on in this video we will talk more about candlestick patterns, but for now just notice that we did have an entry signal right there. And now the question is, where do we set our stop loss and where do we set our target? Well, one method to use is to set the stop loss here below this zone right here. So we set it below the support, and we also leave some wiggle room, so it's possible that the price can go down and test the support once again without us getting stopped out. And what about the target here? Well, as for the target, you can either use a fixed risk to reward ratio. So for example, now you can see that the risk to reward ratio says 2, and that simply means that the reward we get from winning the trade is twice as much compared to what we lose when we lose the trade. So if we use this type of 2-to-1 risk to rewards, it means that even if we only win 50% of the trades, we will still make money over time, because when we actually win, we win twice as much. But while these fixed risk to reward ratios can be a useful tool, especially for beginners, it's very simple. We can actually use an indicator to help us exactly where to place the stop loss and exactly where to set the target. So let's go ahead and take a look at the second indicator now. So the next indicator we're going to take a look at is the ATR indicator. And this indicator can be very nice because it can give us objective levels to exactly where to place the stop loss and exactly where to place the target level. But how does the ATR indicator work? Well, the ATR is an indicator that measures market volatility, or in other words, it measures how much the price moves, or to be more precise, how much the price moves on average. And to simplify the calculation here, what the ATR basically does is that it calculates the average price movement. And the most common period is to calculate the average price movement of the last 14 candles. And 14 is a very common number. Remember, for example, the RSI indicator also uses 14 periods to calculate momentum. And I usually find it valuable to, have harmony between the indicators. So if you use 14 period for the RSI, you might also want to use 14 period for the ATR and so on and so on. And if you change the settings of the RSI, you might want to consider changing the settings for the ATR indicator as well to keep the harmony here between the indicators. But now let's take a look at how do we use the ATR. Well, one use case is to use it to calculate the stop loss. And here you can use a multiplier of the ATR to manage risk. And here different traders will use different values, but a common way is to set your stop loss at 2 times the ATR. You can also use the ATR to find target levels. And once again, you can set a multiplier of the ATR to find your target levels. And this is often relative to the stop loss. So many times, what I mean by this is many times you base the stop loss based on the ATR, and then you base the target based on the actual stop loss. So both the target and the stop loss will be based on the ATR, but it's easier to base the target off the stop loss, if that makes any sense. And the benefits here of the ATR is that it can help us adjust our trading strategy according to the market conditions, or in other words, according to how much the price moves on average. So for example, right here we have an ATR indicator. It's just a simple line. And how you read this ATR is basically, if you for example take a look at right here, we can see that it says 400. This means that on this point, the price moved by 400 on average over the last 14 days. And if you, for example, read the ATR at this point right here, we can see that it says 600. So at this point, the price moved by 600 on average, and so on and so on. All right, so now let's jump back into the chart here, and let's take a look at how to open the ATR and how to use the ATR to take more informed trading decisions. To open the ATR, we want to head over here to the Indicators tab in TradingView, and no surprise, what you want to search for here is simply ATR. And with TradingView, you will always have tons of different variations of the ATR, but just the normal ATR that is called average true range is definitely good enough. So let's open that one up. Now I want to head to the settings tab here, and I just want to change, as you can see, the length here is 14, but you can change this one if you want to, but we want to keep it simple for this video, and the only thing I want to do is make the ATR a bit larger here so you guys can see it clearly. So let's press OK now. And let me also move my camera here so that you guys can see the values of the ATR. And now let's take a look here. Remember, the trade we were looking to take was right here. So what we want to do is that we want to go down to the ATR and read the ATR for that candle. And to be more precise, we want to read it from the green candle right here. We can actually use a horizontal trend line. So you can see we draw a trend line on this level, and you can see that the value here is 0.0021. I'm not going to talk about pips here because that will just confuse many beginners. You just think about this as 0.0021. And now to use the ATR, let's once again click on long position here because we're looking to buy. And remember, we want to buy on this candle right here. And here you can see that when we adjust our stop loss, you can see the value of the stop loss. So for example, if we set our stop loss right here, you can see that it says 0.0021. So right now we have a stop loss of the ATR. We have 1 times the ATR. But remember, a common value to set the stop loss is to set it at twice the ATR. So in this case, it would be right here, right? 0.0042. And if we use this kind of stop loss, we want to adjust our risk to reward ratio based on the ATR. So if we have a 2 to 1, then our target will be at 0.0084, right? 4 times 21 is 84. So this is essentially how you can use the ATR indicator to always have objective rules to set your stop loss and target. Now I want to take a moment to take a look at a very impressive indicator. This right here is the auto chart pattern indicator, and it's a relatively new indicator created by TradingView. And what this indicator basically does is that it helps us to identify chart patterns automatically. And don't worry, we will talk more about chart patterns later on in this video. But here on the chart, you can see an example of a chart pattern. This right here was a recent inverse head and shoulder pattern created on the Tesla chart. You can see we have a left shoulder, we have a head, we have a right shoulder, and when the price broke out from this pattern, look at what happened to the price. The price immediately shot up, and what you also can see here is that this indicator automatically detects target levels as well. So this right here is a very useful indicator. It's a bit different from the indicators we have been talking about earlier, but don't worry, I will show you guys how we can combine this indicator with the strategy we have been talking about. And as I mentioned, one feature of this indicator is that it finds target levels automatically, and that is very, very nice. The only downside with this indicator is that it has a requirement. In order to use this indicator, you need TradingView Premium. However, I have a special link that will be both in the top comment of this video as well as the description. And you can use that link to try out TradingView Premium for free for 30 days. And if you fall in love with this indicator and TradingView Premium, by using the link, you will get a $15 bonus if you decide that you want to continue using TradingView Premium. And also guys, if you use the link, you at the same time support the channel. So thank you all so much in advance. Alright, so to demonstrate how to use the auto chart pattern indicator, I actually do want to change the chart here. I want to go to Tesla, and I want to change the time frame here to a daily time frame. I also want to hide the RSI indicator and hide the ATR for now. And now to open up the indicator, we want to head up to the indicators tab in TradingView. And what you want to search for here is all chart patterns. And the indicator you want to choose is this one right here called all chart patterns. Next, we want to head up here to the settings tab for the indicator. And here you can see that we have tons of different chart patterns, for example, double top, double bottom. And here you can basically choose all the patterns you want this indicator to display automatically on the chart. And here on the in progress tab, you can also choose to display patterns that are currently in the process of being formed. So for now, just to demonstrate, let's choose all the patterns here. And here on visibility, we can also choose to display all the patterns. You can see currently we are just looking at the most recent pattern, but if we press all here, the indicator will show all of the patterns. And you can also here choose to display the price targets or not. But for now, let's show all the patterns and all the price targets. And now we are ready to go down here and press OK. So as you can see, it looks a bit messy here on the chart, but now we can see all the patterns that this indicator found. So for example, right here, you can see that the indicator identified a rising wedge. A rising wedge is when the price prints higher highs and higher lows, but the range here is getting tighter and tighter. And you can see right here, the price broke out from the pattern. And when the price breaks the pattern, you will get an automatic price target. So this right here is a bearish pattern where you bet against the direction of the market, and this pattern was reached at this point right here. Another pattern you can see is the head and shoulders pattern, and this is this pattern that goes like this. This was the pattern I talked about earlier. You can see we have one low right here, which is called the left shoulder. We have a lower low that is called the head, and then we have a higher low that is called the right shoulder. And the reason this is called a head and shoulder is because it's basically it basically looks like a head and shoulder. In this case, it's an inverse head and shoulders. It basically looks like someone's head and shoulder but upside down. But as you can see, in this case, the pattern broke right here. We found an automatic target all the way up here, and you can see in this case, this price target got reached very quickly. We also have a falling wedge right here, which is a continuation pattern. So we had a move towards the upside, the price consolidated here, we broke out, and the target was right here. So as you guys can see, this right here is an amazing tool. But just as with the other indicators, it's important here that these patterns they can be useful on their own, but they are best used when you combine the patterns with other technical indicators. So for example, in this video, we have been focusing on trading an uptrend. And remember, our goal here was to buy the pullbacks and preferably buy at support. And the interesting thing here is that many patterns are continuation patterns, meaning that the goal of the patterns is to continue the trend towards the upside. And we will talk about some continuation patterns later on. But if we find, let's say that we find a falling wedge during this pullback, and a falling wedge is the opposite of the rising wedge here. So it's basically when we print lower highs and lower lows, but the range here is getting tighter. If we find a falling wedge and it breaks out here near the support level, that is yet another confirmation that can increase the likelihood of a successful trade. So you can definitely combine chart patterns with trend trading to improve your probabilities of succeeding, and as a result, increase your profit. But as I said, guys, if you want to try out this indicator, make sure to use the link in the description or in the comment, and you will get a $15 bonus towards your new plan. So now, guys, the time has come to take a look at candlestick patterns. Candlestick patterns is one of my favorite concepts in technical analysis because they are pretty simple to learn, and if used correctly, they can be a very powerful tool and give an indication of where the price is likely to go next. So, what are candlestick patterns? Well, candlestick patterns are visual representations of price movements during a specific time frame that gives hints about where the price will go next. Or to be more specific, where the price is likely to go next. No candlestick pattern can predict price movements with 100% certainty, and as with all technical tools, they are best used when you combine them with other technical variables. And when it comes to candlestick patterns, they are often relatively small. We are talking about maybe 1 to 5 candles. If you, for example, compare candlestick patterns to chart patterns can often be much larger, as you saw earlier in the course. And we also have different types of candlestick patterns. We have bullish patterns, which signals potential price increases, and we also have bearish patterns that signals potential price decreases. We also have reversal patterns, and reversal patterns indicates a potential change in trend direction. So remember the inverse head and shoulders we talked about, that is an example of a chart pattern, a reversal chart pattern, because before the pattern appears we have a downtrend, and the goal of this pattern is to reverse the price to the upside. But when it comes to candlestick patterns, these are often much smaller reversals. So if you, for example, have an uptrend, we can find a reversal pattern that simply reverse the pullback. So these are often much smaller reversal patterns compared to chart patterns. And we also have something called continuation patterns. A continuation pattern should suggest that the move will continue. So once again, for example, if we have a trend, you might find a continuation candlestick pattern within the actual impulsive moves that sort of suggests that the impulse will continue. Now, let's take a look at some of my favorite candlestick patterns that you definitely need to know about. The first candlestick pattern you need to learn is called the bullish engulfing pattern. And this pattern is a complex pattern. Why do we call this a complex pattern? Well, I call all the patterns that consist of 2 or more candles complex patterns. The direction here is bullish and the type is reversal. So before the pattern, we have a downtrend, and these two candles are the actual bullish engulfing pattern, and the goal of this pattern is to reverse the price to the upside. So to identify the pattern, you first need to identify a move towards the downside. And remember here that this move can be a pullback, so it can simply be a pullback in an uptrend. And the goal of this pattern is to reverse the price. The first candle of the pattern is a red one. And the next candle is a large green candle that opens below the real body of the red candle and closes above the real body of the red candle. So it needs to open below the close of the red candle and close above the open of the red candle. It's also fine if you have the red candle like this and that the green candle opens at the same level of the red candle but closes above. This right here can also count as a bullish engulfing pattern, because in some markets the next candle will always open where the previous candle closes. So both of these variations are fine. All right, so let's jump back here to the chart. You are probably, very familiar by now. This is the 4-hour time frame, US dollar measured in euro. And here I actually want to show you guys a bullish engulfing pattern. If you look closely, you can see that right here we actually saw a bullish engulfing, right? If we zoom in on this candle, you can clearly see that this green candle opens below the body of the previous red candle and closes far above the body of the previous red candle. When this candle closes, so when this 4-hour candle is done, the bullish engulfing pattern is confirmed, and this is a potential buy signal. But remember here, in order to find a good buy signal, what we want to look out for in our trend continuation strategy is that we want this bullish engulfing to come at a support level. And here you can see we have a support, and this support comes from the swing high right here. The price went down, we broke above this level, and then with this bullish engulfing pattern, we tested this previous resistance as support. So this right here is a valid buy signal, so we take our long position. And where do we enter? Well, the most common way to enter the bullish engulfing is to enter here at the candle close of the green candle. That is when the pattern is confirmed. And as for your stop loss level, you know by now that we have a few different methods to set stop loss. A simple method is to set the stop loss below the support, so you can set it right around here. The second method is, remember to use the ATR indicator, which we have down here. But to keep it simple for this example, we can use a fixed risk to reward. So we set the stop loss just below the support level, and using a risk to reward ratio of 2, your trade would have looked something like this. You can see this was a very nice example. Just a few candles later, we locked in some nice profit. The next candlestick pattern you definitely need to learn is the hammer pattern. The hammer pattern is what I call a simple pattern because it consists of only one candlestick. The direction here is bullish, and the type here is once again a reversal. So before the pattern, we need to see a move towards the downside. Once again, this can either be a pullback or it can be a larger impulsive move. Then this right here is the actual pattern, and the goal of the pattern is to reverse the price to the upside. To identify the pattern, what you're looking out for is that you're looking out for a candle with a small real body and a long lower wick. And we want this wick to be at least twice the size compared to the length of the real body. And preferably we want the wick to be maybe 3 times or even 4 times as large as the real body. Also, when it comes to the upper wick right here, we want this wick to be either small or non-existent at all. As a rule of thumb, we want this wick to at least be smaller than the body of the candle. But now let's jump back here. We're looking at the exact same chart as before. I think it's a good way to, just show the same chart all the time, so we can see that these kind of signals happens all the time. And the question here, can we find a hammer on this chart? Well, I can't really find a good hammer here. One could argue, if you look at this candle, you can see this candle right here. Let me actually zoom in here even more so you can clearly see. You can see for this candle, we indeed have a small real body, right? And we have a pretty long lower wick. We can see that this wick is probably more than twice as large as the real body. So if you only look at the actual pattern, this is actually a hammer. But remember here, in order to have a valid hammer, we want the move before the hammer to be a downwards move. And in this case, we can actually see that the candles here before the hammer was pretty much just going sideways. By the way, these two candles right here have a special name. They are called doji candles, and they basically represent market indecision. But for now, we can notice that we did not really see a downwards move from this candle. And the other problem with this candle is that it did not appear at a support level. You can see our support is all the way down here. So this candle pretty much appears in the middle of nowhere. So in this particular case, this was not really a good signal. And this is something very important about trading. You will find sort of small signals all the time, but we as traders only want to focus and we only want to take trades on the best signals. Alright, so next I want to take a look at the bullish momentum pattern. This right here is a super useful pattern because it happens all the time in the market. This right here is a simple pattern because it consists of only one candlestick. The direction here is bullish and the type here is continuation, meaning that the goal of this pattern is to continue the preceding uptrend to an uptrend even after the pattern. However, it's a bit too simplistic to say that a bullish momentum pattern is only a continuation pattern, because a bullish momentum pattern can also act as a reversal as well. For example, many engulfing patterns will actually be both a bullish engulfing and a bullish momentum at the same time, and you will soon know why. Because what is a bullish momentum pattern? Well, I like to define this as a candle, a strong green candle that is at least twice the size of the previous candles. And preferably we want the momentum candle to be even larger, maybe 3 times or 4 times as large as the previous candles. And as a rule of thumb, what I usually do is that I measure around 3 candles before the momentum candle appears. And if the actual momentum candle is at least twice the size, I will consider this a bullish momentum. And let's jump back here to the same chart as before. Let me delete this one. Let's see if we can find any, let's see if we can find any bullish momentum candles. Well, if we take a close look right here, we can see a strong green candle. We can also see that before this candle appears, we have a slight upwards movement. And what we also notice, if we take a look at the previous 3 candles, we can see that the body of this candle is more than twice the size compared to the bodies of the previous candles. So we can consider this a bullish momentum. Another good thing about this momentum candle is that we actually see the candle coming in here near a support level. This was not a perfect support because the price actually dipped below just slightly. We saw like a few fake outs of this level. But remember from earlier in the course, we are still in an uptrend because we are still printing higher highs and higher lows. As long as we don't break below this area right here, we are still within an uptrend. So now last but definitely not least, let's take a look at chart patterns. Chart patterns are much larger than candlestick patterns, and they can be a bit harder to master. But at the same time, when you learn to use chart patterns correctly, and also when you learn to combine chart patterns with other technical variables, the outcome can be really rewarding. But first of all, what are chart patterns? Well, once again, chart patterns are visual formations on price charts that help to predict future price movements. So for example, right here, we have a chart pattern. This right here is known as a bull flag, and it's one of the best chart patterns out there. We will talk about how to trade the bull flag very soon. And one of the key differences between chart patterns and candlestick patterns, as I already mentioned, is the size. Chart patterns are large. They usually consist of 10 to maybe 50 or even more candles. And what are the components of a chart pattern? Well, chart patterns uses support and resistance, and by now we are very familiar with support and resistance. Chart patterns also use trend lines. And what is a trend line? Well, a trend line is basically a sloping resistance or a sloping support. So the principles we talked about earlier in the course can basically be applied for trend lines as well. And what is the usage here of chart patterns? Well, we use chart patterns to identify entry and exit points in the market, and we also use them for risk management. The first chart pattern I want to show you guys is called the ascending triangle. And in my personal opinion, this is one of the best chart patterns because it provides very clear buy signals, and we also have very clear levels for where to place our stop loss and where to place our targets. This pattern right here is a bullish continuation pattern. So before the pattern appears, we want to see a move towards the upside. Then this sort of red part is the actual pattern, and the goal here is to continue the price movement towards the upside. To identify an ascending triangle, we first need to identify a resistance level. Here you can see that we have a clear resistance. The price got rejected multiple times at a level indicating selling pressure. The next thing we need to identify is that we want to see higher lows. So here we have a low, here we have a higher low, yet another higher low, and yet another higher low. So what we then do is that we draw a support line like this. And now this is a bit ugly, but you can hopefully clearly see that a triangle is created between the resistance and the support. Alright, so here is a real life example of the ascending triangle. As you can see, we have a move towards the upside. The price clearly finds a resistance. You can see we get rejected 1 time, 2 time, 3 time, 4 time, we get rejected here. And at the same time, we're printing a low, a higher low, and higher low. And now you might of course wonder, how do we actually trade this pattern? Well, the most common way to enter this pattern is to enter on the breakout, or in other words, to enter on the candle close of the actual candle that breaks the pattern. The stop loss for this pattern is usually set below the most recent low before the breakout. And as for your target level, what we usually do is that we measure the length from the stop loss to the target, and we use a fixed risk to reward ratio, such as a 2-to-1. But what you also can use is that you can of course use the ATR indicator to adjust your stop loss based on the market volatility. Now, the next pattern I want to show you guys is the bullish flag. Personally, I really like this pattern, and this pattern is also perfect for this video because this right here is a bullish continuation pattern, and what we have been focusing on in this video is trading in the same direction as the trend, and this is exactly what the bull flag pattern does. What we need to identify to find a bull flag is that we first need to identify an impulsive move like this, and then we want to see a pullback. This is very simple. A pullback, which is a move against the direction of the trend. And in this pullback, what we're usually looking out for is a few lower highs and a few lower lows. And remember from earlier in the course, this is still an uptrend until the price breaks below this point. So this right here is basically like a small downtrend within the uptrend. If you zoom into shorter term timeframes, you will be able to actually find larger trends within the longer term timeframes. So let's actually see if we can find a bull flag on this trend we have been talking about. To make it a bit more clear here, let me actually delete some of these black lines. I don't think we need them anymore. You know about the structure of trends. But for example, this was not perfect, but this can almost be considered a bull flag. So we draw a sloping line like this, we draw a sloping line like this, and what you can see here is that the price moves down, tests the support, moves up, moves down once again, and then we finally broke above the bull flag. However, this right here was far from a perfect bull flag, and I think it's important that I show you guys examples that are, not perfect patterns, because when you are trading in real markets, you will realize that so many times the patterns will be far from perfect, and you may wonder what is making this not a perfect bull flag. Well, when it comes to bull flags, what we're looking out for is that when we break the downward sloping resistance, we preferably want to see a strong candle. And as you can see, when we broke this resistance right here, we didn't really see any kind of strong momentum. So this right here was a bull flag I would have avoided. So for example, in this case, the test of the support we talked about earlier, so this test right here was, at least in my opinion, a much better buy signal compared to the signal from the bull flag. To show you guys a better example of a bull flag, we have one right here. You can see we had an impulsive move, the price went down, tested support, up again as resistance, down again as support, and then we broke the pattern right here. And what made this a good breakout was that this breakout candle was a pretty strong breakout, making the pattern more likely to actually succeed. So the common way to enter is to enter at the candle close of the breakout candle. The stop loss is usually placed below the low of the bull flag. And as for your target, you can use a fixed risk to reward ratio, or you can use the ATR indicator. You can also definitely combine the bull flag with other technical variables such as the RSI indicator. And remember, if you want to use an indicator that identifies bull flags automatically, you have the auto chart pattern indicator. So now last but definitely not least, we of course have to take a look at the double bottom pattern. This right here is an amazing pattern, especially for beginners, because it's very simple to spot, and if you master the double bottom, it can definitely be a useful pattern. So this right here is a bullish reversal pattern. So before this pattern appears, we want to see a move towards the downside. Then what we're looking out for is that we're looking out for one and then two lows here at the around same level. These two lows doesn't have to be on the exact same level, but they should be around the same level. And what we then usually do is that we draw a horizontal line here that connect the high between these two lows. And what we're looking out for is that we're looking out for the break of this level, or some traders actually specialize at trying to buy on the second low. So here is a real life example of the double bottom. You can see that we have a move towards the downside. Then we see one low and two lows appearing here at the around same level. And then at this point right here, the price broke above the resistance that comes from the highs here in between the two lows. And the most common way to enter is to enter at the breakout. So the entry is usually placed at the candle close of the breakout. The stop loss is usually placed below the double bottom, so below the lowest low. And as for your target, you can use a fixed risk to reward, you can use the ATR indicator, or you can use other market structure. But as I said, some traders also specialize in trying to buy the low here. This can be a bit harder. And if you do this, what I definitely recommend is that you have multiple other bullish confirmations, increasing the likelihood of this being a successful trade. And if you look closely at this candle right here, we can actually see that this counts as a bullish engulfing. This is a case when the green candle, or in this case the white candle, opens at the same level as the red candle, but you can see that the close of this candle is clearly above the real body of the red one. So here we can see this as a bullish engulfing. So some traders might have tried to enter right here already at this candle close. The good thing about this entry method is that you enter at a cheaper price. You also have a pretty clear stop loss. And to, for example, reach a 2-to-1 risk to reward, the price doesn't have to rise as high compared to the other entry method. As I said, this entry method is a bit harder and maybe not suitable for beginners. Alright guys, so this course is actually coming to an end very, very soon. But real quick, before we wrap up here, I just want to thank you all so much for watching. If you guys did find value and enjoyed this course, the absolute best way to support the channel is to drop a like on the video. And another way to support is of course to use any of the links I have been talking about during this video. And also guys, of course, if you have any kind of questions or feedback about this course, please don't hesitate to drop a comment down below. I will try my very best to answer as many comments as possible. And last guys, but definitely not least, when you are ready to continue your trading journey, I highly recommend to check out this playlist right here. In this course, we talked a little bit about technical analysis, but there is so much more to learn. So when you have the time, I highly recommend to check out this playlist. It contains all the educational trading courses I have made on the channel.